Hello and welcome to KYC, a brand new show at NDTV Profit. In this fast-paced world of stock markets, investors are bombarded with information, but what they often lack is a deep, comprehensive understanding of the companies they invest in. Know Your Company is a show designed to give you regular investors powerful, actionable insights into the company's fundamentals of a single NSE-listed entity every single day. And today we're taking stock of a rather well-known infra company, NCC. Now, this is a Hyderabad-based company, and the company is in fact the second largest construction company by revenue. It is involved in construction and infrastructural development, and in terms of various projects, they do work around buildings, transportation, water, as well as environment, along with electrical transmission and distribution. They also do have a lot of projects with respect to irrigation, mining, and railway sector. In fact, let's put the spotlight on how this is split in terms of, your various, revenues in terms of order books, pardon me. So when it comes to the order book specifically, the largest portion of this comes essentially from buildings, as you can see, that's 37%. That is followed by, about 21% from transportation and another 21% from waterways and railways. Electrical transmission and distribution, and then you have about 12% of your order book coming in from, waterways and railways. They do have a relatively smaller, pie of the order book from mining as well, and a marginal one coming in from irrigation and others too. So a very well-diversified company in terms of the order book, as well as in terms of the execution too. It's not like you will have very lumpy recognition of revenues, because as you can imagine, there is a time-to-time revenue recognition once the execution comes through. So, as we always do, if we consider all the companies and we take a look at how the company has done in the past few years, and we also take a look at what are the factors that may be working in favor and against all these companies. So, as usual, we start by taking a look at the income statement. We take a look at the order book, at least as far as the infra companies are concerned. That's another very important factor, which gives you an idea about the visibility going forward. Besides that, we're going to take a look at the balance sheet as well as return ratios. And among other parameters, we take a look at the cash flow statements. Of course, shareholding will also be somewhat of an important factor, because it gives you an idea about what the promoter holding is, what the institutional holding is, how much of that shareholding is out in the public. And then, of course, what the street is making of with respect to this particular company, not to forget the street coverage specifically. With that, let's talk about the income statement. Now, the company has been on a very strong footing. As you can see, firstly, from revenues of around a little over 11,000 crores back in FY22, it's nearly doubled to in FY24. And as you can see, on a year-on-year basis, when it comes to revenue growth, it has been substantial. This, bear in mind, is on execution of its projects that it already has. And as you can see, nearly 21,000 crores in terms of revenue in FY24 does mean that it has a substantial, a footing as far as the infrastructure space is concerned. Even in terms of your margins, they're holding on within 8.5% to 9%, 9.5%. Sure, we've seen a little bit of temperance in FY24, but these are relatively healthy margins, as you can imagine. And of course, we are also seeing a gradual improvement in its profitability as well when it comes to the bottom line. Moving on, in terms of your 3-year CAGR, we've seen the revenues rise 38% and your profit has grown around 41%. So very, very steady growth coming in. How has the first half of this financial year been, you may ask? Well, that's also been pretty good, because if you consider the revenues for the first half of this financial year, we've seen about 18% growth. Do remember that there is a bulk of execution that takes place in the second half of the financial year, seasonally, for a lot of these infra companies. So, based on that, we are looking to see a further improvement when it comes to the second half of this financial year. That said, its EBITDA has also grown around 29%. We've seen margins also improve to around 8.6%. The question really is that can it move back to the mark of 9% in terms of its operating margins, as has been the case in FY22 and FY23. So that's something that we need to well keep an eye on as well. And profits, of course, are moving up around whopping 47% as well. So again, the first half of this financial year has not been very different in terms of how things are panning out with respect to your top line as well as the bottom line going forward. And which is why, given the kind of traction that we've seen, we'll give it a thumbs up with respect to your income statement. Now let's look at your order book position. Again, the reason why this is important is because, well, it just gives you that much more visibility. You've seen that the company has made 20,000 crores in the top line in terms of revenue. Its current order book as of September 2024 stands at around 52,000 crores, which is 2 times the revenue it has made back in FY24. So that is obviously another positive, which gives you a good amount of visibility over the next few years. Also, in terms of order book, that stood at around 4,600 crores, rather inflows coming in. So the inflows are coming in steady as well. In fact, we've seen the FY25 guidance for order inflow also standing at around 20,000 to 22,000 crores, and that is also substantial. In fact, if you consider and look at how things have panned out over the prospective project line, that stands at around 2.1 lakh crores. Now, the reason why this becomes important is because we are moving into the fourth quarter, and the fourth quarter tends to be a quarter in which the awarding activity for the entire sector improves and increases dramatically, because that's where a lot of your awarding will come through. Well, this is, of course, largely post-budget, but want to take a look at how this order book has also grown gradually over the last few years. So again, from 40,000 crores back in FY22, that's gradually moved up to nearly 57,000 crores. So a near 50% growth there as well. Of course, we've already spoken about the kind of up move the revenues have seen, but the book-to-bill ratio, that has, well, tempered up. That comes to around, 2.7% in FY24 as against 3.5 times. But remember that FY24 was a year in which we did have the general elections, which means that there was a little bit of slowdown in the awarding activity there as well. But when it comes to consider the overall order book position, it does seem like it's in a very good place right now with the kind of visibility that we are seeing and working with, and which is why we give this one a thumbs up as well. Moving on to the balance sheet. Now, this is again an interesting one, because if you consider the net worth of the company, that's the shareholders' value, well, that stands at around a little less than 6,900 crores. In comparison to that, we have a long-term debt which is negligible at around 57 crores and short-term debt of around 1,600 crores. However, if you also consider, the cash and balance, the cash in bank, that also stands at around 851 odd crores, which gives you a net debt of around 775 crores. And hence, even if you consider the overall net debt to equity ratio, that is much, much lower than your average infra company would have and stand to gain. And which is why, once again, NCC, as one of the leading infra players in the country, is on a strong footing yet again, which is why we'll give it a thumbs up as far as the balance sheet is concerned too. Now let's talk about return ratios. Now, we have to understand that when it comes to infra companies and return ratios, they tend to be lower. But in this case, of course, we're seeing an improvement in return ratios as well. So for FY24, your return on equity moved up to around 9.6% against 9.4%. And your return on capital employed also moved up to around 14% against 13.4%. So while these ratios are lower than your benchmark 20%, we're seeing an improvement, which is why we'll give return ratios a neutral rating as well. Overall, so far so good as far as its income statement and the balance sheet is concerned. What about cash flows from operations? This usually tends to be a challenging area for most companies in the infrastructure space, but it does seem like cash flow wise as well, if you consider just FY24 and FY23, cash flows from operations, we're actually looking at an improvement, and we're also looking at a substantial improvement in terms of your net cash flows. So free cash flow is certainly something which is contributing to the balance sheet here as well. Now, if you consider September 2024, we're looking at an outflow, but we must remember that this is just mid-year. So we must wait for the end of FY25 until we get an idea, an overall understanding of how the net flows have been for your financial year. But going by what we've seen in the past, where there could be a possibility that it will very much be in the green in this case as well. But that's, of course, based on the probability. But it'll be a thumbs up for the cash flow statement check as well. So certainly, a promising factor there as well. So this is as far as your three most important financial statements are concerned: the income statement, the balance sheet, and the cash flow statement. And based on that, steady return ratios too. Let's move on and talk about a handful of other factors. And by that, I mean, we talk about shareholding. Now, in terms of shareholding, the promoters only hold 22%. We do have substantially high shareholding when it comes to institutional activity. So another 21% is held by foreign institutions, that's FPI, and domestic institutions hold around 12% as well. So about 32% overall is held, or rather nearly 33% is held by institutions, and the balance 45% is held by public. I'll give this a neutral rating because we still have a large chunk as free float as far as NCC is concerned. And which is why, it's not necessarily a negative, but we will give this a neutral rating going forward. And then comes down to what the stock has done based on the kind of traction that we've seen. So, notwithstanding the last 6 months, and last 6 months have been very challenging for the entire market, especially the October, November, December period, which is why we've seen a temperance. We've seen a 16% correction in the last 6 months. However, if you consider the last 1 year, massive outperformance. So 67% growth. Do remember the mid-cap and the small-cap indices have moved up as much as 22 to 25% in the same period of the last 12 months. So in comparison, there's been a huge alpha that's been created by NCC going forward. And, in terms of the last 5 years has been as well a clear case of a multi-bagger here. It's moved up around 380%, so nearly 5 times in terms of the kind of returns it has given to shareholders. I just want to add one point to the shareholding pattern as well. There are marquee investors who are also invested in the stock. Rekha Jhunjhunwala specifically, in this case, also owns about near about 12%, 12 to 13% in the company. So even in the public shareholding as a whole out there, and in terms of outstanding, we do have a lot of key marquee investors invested in NCC. Finally, coming down to street coverage, that is something that we want to talk about. Again, the stock does have an upside here, about 26% upside entailed with the kind of consensus that we're seeing. Now, the consensus as a whole has about 14 analysts covering the stock. And of the 14 analysts, we have 10 analysts who are, in fact, positive, and they have a buy rating on that. We have 3 analysts who have a sell rating and 1 on hold. So overall, it does seem like, it's a fairly stable footing. Now, if you consider all these 8 factors, what does this all come down to? What does this all mean? So, as I mentioned, it's a thumbs up for the income statement, it's a thumbs up for the order book positioning, balance sheet, return ratios, as well as cash flow statements. Shareholding is a neutral, sure, and besides that, we have about street credentials, and street coverage is fairly positive too. Want to make a very quick mention of street credentials because that's something that we should mention, and that's dividends. If we can very quickly go to that dividend payout bit as well. Now, it has a dividend payout ratio of around 22% for FY24. It's been nearly the same at FY23 as well. This is a fairly stable dividend payout ratio, especially given the kind of growth that we have seen in the company. So it does give out about 1/5 of its profits out in terms of its dividend, especially given that its promoter holding is not as high. So this certainly is a positive, and it adds to street credentials because of the kind of growth we have seen in capital appreciation as well. Let's come down to your total ratings then. Yes, so we have a total rating of around 7 out of 8. And remember that of these 8 points, we have no negative points, no thumbs downs. We have 2 neutral stances, which comes to an overall well, rating of around 7 to 8%. Now, that said, if I can very quickly go through the outlook coming forward as well, it's something that we're going to talk to the management about as well. The company has guided for an order inflow of around 20,000 to 22,000 crores, the revenue growth of over 15%, and the EBITDA margin guidance of around 9.5 to 10%. So those are the key takeaways. But with that, let's shift focus and listen to the management itself. So earlier, I did speak to, well, the management of the company when I spoke to Neeraj Sharma. He's the head of strategy at NCC. And I discussed the growth plans as well as the order book and the guidance. Listen in to that conversation.
As you are aware, we have published the H1 results a few weeks back, and we have been able to deliver about a revenue growth of upwards of 13%. And the first quarter, you also talked about the order book. I also take this opportunity to share with you the fact that at the start of this financial year, we had shared 3 sets of guidance numbers with the market. The first number that we had shared with the market was an order inflow guidance, which is 20,000 to 22,000 crore. And I'm happy to report that, if we really take into account the projects that we have bagged in the Q1, Q2, and as of today, we have already achieved close to 60% of this lower band. What I wish to share with you, the fact that we are quite confident to achieve the inflow guidance that we have shared with the street. The second number that we have shared with the market is revenue growth upwards of 15%. I have already brought to your attention the fact that we have already delivered about 13% revenue growth in the H1. The third number that we had shared with the market is a margin guidance that is 9.5 to 10% EBITDA margin. And we are hopeful and optimistic as we speak to even achieve these numbers by end of FY25.
All right. Okay. And in what areas are these projects in terms, if you could give us an idea of the split of this order book, where is the most of these projects, or rather, what areas are most of these projects coming in from?
Sure. The order book that we had at end of September was a number which is 52,370 crore. I repeat, 52,370 crore end of September. When we talk about the contribution from different divisions, the largest contribution of 37% comes from our largest division, what we call buildings division. The second largest contribution from our transportation division, that is 21%. Again, 21% is also the contribution from our third large division, we call electrical T&D. And the fourth largest contribution comes from our water division, which is about 12%. These are the 4 large divisions, and the rest about 10% comes from our relatively smaller divisions, which is railways, irrigation, and mining. So these 4 large divisions that I just talked about contribute more than 90% of the order book that we have.
All right. Neeraj, looking into the fourth quarter, it tends to be the quarter in which you have the most amount of awarding activity. And I'm not just talking about NCC in general when it comes to the entire sector. Could you give us an idea about your expectations? I'm not asking for specific numbers, but some sort of an idea as to what could be in store. And the reason why I ask you is because last year, same time around, the awarding activity had ceased to a certain extent because of general elections, but this time around we won't have that challenge anymore. If you could give us an idea here.
Yeah, let me try to answer that question a little differently. In the first quarter, as you rightly pointed out, we have had central government elections and practically hardly any awards, in the Q1. We have only also received only 400 odd crore inflows. The first quarter has been, as a washout quarter, not really for NCC, but industry as a general. I mean, talking about the people who are focused on this infra vertical. The second quarter also, we have, felt the after effects of the central government, what happens is, the people are in places, the policy direction is clear from the new people who are nominated to the cabinet. And we have also felt, the after effects of this process in most of, Q2, if not all. But things are picking up. Things are picking up. And as I have shared with you, we have already achieved till today about 60% of the lower band. And we are very optimistic that, things should pick up. Now the Q4 is just a couple of days away. Things should pick up in Q4, and we are reasonably confident to achieve the inflow guidance that we have shared with the market.
Okay, sure. Well, can you give us an idea about your balance sheet at the moment, how and where debt stands? Are you looking to reduce debt perhaps to a certain extent, or are you comfortable with these debt levels at the moment? And also an idea on the kind of cash flows that you are witnessing. I don't want to judge the company by cash flows, based on the mid-year. I suppose that a better number would be taken towards the end of the year. Still, if you could give us an idea about some of these aspects too.
Sure. Two questions. Firstly, I will talk about the debt part. As of H1, we will have debt close to about 1,500 to 1,600 debt number. But this industry is a little different, cyclical kind of industry in which the players are expected to invest working capital generally in the Q1 and Q2. And this intensity starts going down in the Q3, and this really hits the lowest point by end of Q4. In the FY24, the net debt, if we really talk about the net debt number, it would be close to 500 crore plus. And by end of FY25, we expect to be close in that range only, that is 500 crore plus net debt. You also talked about the cash flows. You rightly highlighted, the H1 results really do not talk about or highlight the quantum of cash that is generally, generated from the operations. If I really talk about FY25, I think we had generated close to 1,350 crore of net cash from our operations. And this year also, we should be able to be close to that number.
Okay. There was some talk about smart metering as well. At least as far as your conference call is concerned, there was a mention that there has been some deference in terms of certain orders with respect to Maharashtra. Can you give us an idea about where that stands, and your plans in terms of smart metering going forward as well?
Sure. Firstly, I will try to brief you and your viewers the fact that last year, we had bagged 3 smart meter projects. 2 projects were from this state of Maharashtra. The order value of these 2 projects from the state of Maharashtra would be close to 5,700 crore. The third project that we bagged was from the state of Bihar, which is about 2,300 crore number. In the state of Bihar, we are making good progress in the rolling out these smart meters. In the state of Maharashtra, you are aware that we have had state government elections, and there was some delay. We have been asked to go a bit slow on the execution of smart meters. Now the elections are very much behind us. There is a policy direction generally available from the state government, and we expect these projects to now start making good progress. The second question was about our outlook. The smart meter is part of very ambitious flagship scheme of central government that is called RDSS. About 25 smart meters are required to be installed at the premises of the households and commercial establishment. The procedure just start. And as and when we are able to make some good progress in the 3 projects that I just talked about, there is a learning curve. Then we will take a view then we will take a view which projects are really coming up for bidding, what kind of execution skills are required to really, successfully execute those projects, then possibly we will take a view.
All right. Neeraj, you mentioned about the mix of your overall, order book right now. If I were to consider a period of 3 years down the line, are you witnessing any areas which are emerging which would perhaps have a slightly higher mix 3 years down the line as compared to what it has been at the moment? How are you looking at things develop, shape up for NCC going forward?
Very interesting question. Give me a couple of minutes to answer that question. Essentially, our business is a play on the opportunities which are available in the market. There would be some few years in which there is focus from the policymakers to execute certain kind of projects. For example, the smart meter project. This was not an active market couple of years down the line. It just started, And as we are an active participants in the emerging, segments of the market, we expect this mix to change. But to what extent will that really change is difficult to predict at this point of time. Let me also add a small nuance to this. For example, the smart meter, the contribution that this gives to our order book was totally missing, a couple of years down the line. Similarly, we have bagged one tunnel project, in the GMLR project. It's a TVM kind of, underground tunnel project. So we are very actively present in all the upcoming areas, and as and when a suitable project comes up for bidding, we try to look at the risk-reward, equation and accordingly decide to bid for all these projects.
All right, there you have it. That's the management of NCC telling us about what, 3 years could potentially look like. But on that note, we're completely out of time on this edition of KYC. Lots more lined up on the other side. Stay tuned in. We'll be back just a bit.